Are scary markets here to stay? August and September were bad for the markets. S&P down 6%, bonds down 3.5%, NASDAQ down 8% in 2 months. Rough and tumble for sure. Some perspective, third quarter is typically the toughest time of the year for markets. But there truly are some scary headlines out there. Israel attacked, over 1,000 people dead. Conflict in Gaza. How much does this escalate into something larger? Ray Dalio says there's a 50% chance of World War III. Jamie Dimon for JP Morgan Chase warning of potential escalation. You've got a 30-year mortgage rate now at 8%, slowing growth, slowing economy, and now energy prices are surging again. Does that mean inflation is going to come raging back? If you look at the 70s and 80s, when inflation was going down, the stock market went higher. But when inflation was going up, the stock market was falling. It seems like we have the potential to see that again. The rally we've seen in stocks is coinciding with a fall in inflation. If inflation comes back, the markets could get hurt. It's a real possibility. What's an investor to do? Are you better off putting all your money in a CD, selling everything and getting out of the way? The biggest positive in this market today is really seasonality, seasonal strength. The fourth quarter is the strongest of the year, really double of any other quarter on average. Almost half of all growth in the market on average comes in the fourth quarter. What's more, according to research from Carson, when the market is up the first half of the year, then down in August and September, since 1950, there's been a 93% chance that the market ends higher in the fourth quarter. That's a big positive. Now, there are a bunch of negatives in the market: headline risk, concerns fundamentally about higher rates for longer, about international conflict. Some inside baseball are technical indicators about the market. They're mixed. About 55% bullish, 45% is bearish. We've moved slightly more conservative as a result, really across the board. Here are my best tips for dealing with a scary market. Number one, don't be emotional with your decisions. Being emotional as an investor is one of the worst things that you can do, because you end up buying at the absolute peak and selling at the absolute low. If you're going to make any changes in your portfolio, you've got to make sure that it's deliberate, your eyes are open, you've got a strategy behind what you're doing. You're not just being emotional about it. Strategy number two, ask if you have risk management strategy as part of your plan. How are you managing risk? Is it a buckets of money approach where you've got some of your short-term needs set aside and your long-term needs, you're more okay with the ups and downs? Is it a diversification strategy? Is it about being more active and how you're allocating? What is your risk management strategy? If you manage money for yourself, it's an important question to ask. How am I going to be managing risk? If someone else is managing your money, it's also an important question to ask. What is our strategy for managing risk? And this becomes much more important the older that you get, the closer you get to retirement, and the more that you rely on those investments to provide for income in retirement. The reason that is because volatility can kill your financial plan. If there's too much volatility early, you can run out of money, and you want to make sure that that doesn't happen. So you want to have a conversation about what is your strategy for managing risk. Number three, understand what is your investment strategy. How does it fit in your plan? What are those plans' strengths? What are those plans' weaknesses? Or do you have more international? Do you have more in small cap? If you do, the past couple of years have been a little bit bumpy if those two sectors of the market have had challenges. Doesn't necessarily mean you abandon that as a longer-term strategy, but you should at least ask the question, why? Why do we have those as part of the portfolio? Why is that causing the portfolio to lag? What could we do differently? And what is the market? What are the best opportunities in the market now? Strategy number four, explore buffered strategies. This is something that's really important. Buffered ETFs are becoming more and more commonplace, and definitely you should be aware of how they could enhance your portfolio. They're not going to be right for everybody. There's pluses and minuses to every strategy out there. But buffered strategies help buffer you from declines in the market. Could be 10%, could be 20%. They help provide some measure of protection. These ETFs are liquid. You can get in and out of them anytime you want. And there's no free lunch. There's fees associated with them. There's upside that might be capped. But in a market that's sideways, in a market that's range bound, they could be an effective strategy. And if you haven't heard of them before, you need to get some education and learn more about them, how they might be a part of your plan in an uncertain market, or in a market that might be giving you conflicting signals of where it's headed in the short term. Also explore longer term buffered strategies. We're going to talk about one of those here today, RILAs, how they fit in your overall plan. Shorter term buffers are very interesting, but longer term buffers are very interesting in this type of environment as well. They also offer a buffer of protection, but because they're longer term, they may offer you more upside potential. Make sure you look at the positives and negatives of any strategy, but the important thing is you got to have your eyes open about what strategies are available and how they might fit you. Strategy number 5, evaluate your bond strategy. This is so important. Bonds are having their third negative year in a row. Over the past 2 years, down over 18%. It's been a brutal year for the aggregate bond index, down again. What is your bond strategy? And if your bond strategy has been passive and you haven't been doing anything over these 3 years, even though the Fed has told us that they're going to be raising rates along the way, then you have not had a very effective fixed income strategy. For us, we've been shifting over the past couple of years, had more short-term bonds with decent yields. We've been using other instruments like barrier ETFs. There's things that you can do, but the question is, what is your level-headed, unemotional strategy for dealing with the market as it is, in the environment as it is? Sometimes the strategies that work for the past 10 years don't work for the decade ahead. What is your strategy? What is your bond strategy? Number 6, why international? And we've talked about this for quite some time. International has lagged for over a decade. And the question is will it continue to lag in the future? There's been periods of outperformance. 2001 to 2008, international did better than US markets. But there's an interesting dynamic today, and that is the top 7 companies in the US. Those companies are making up a big portion of the upside of the market year to date. And the question is can these international companies that are not as tech heavy as some of those US companies, has that fundamentally shifted where international could lag for the foreseeable future? It's a good question to ask. In a volatile and a scary market, does it make sense to have international as part of your plan? Number 7, will you keep up with inflation? We're concerned about volatility. We're concerned about risk, but you also have to be concerned about another one, and that is inflation. We've got a big fat national debt, over $33 trillion and growing. We're adding to the deficit every year. The value of the dollar is held up pretty well, but will that continue? And will your money keep up? It's one of the reasons why you have to be careful about pulling all of your money out and going to cash. You want to make sure you're earning something, even in those safer instruments, and do the best you can to keep up with inflation. That's the bigger picture. You got to make sure that to manage volatility, you may want to get more conservative, but you have to keep a vision. Is my strategy going to help keep up with the rising cost of living and with inflationary pressure? My final strategy, number 8, anyone can get out, but can you get back in? For people that come to me say, Scott, man, why don't I just pull everything out? I don't want to deal with all this. I don't want to deal with the headache. I want safe money and you can get a good return. You know what? There is some viability to that more than there has been in a long time because of the yields that are out there. You might want to reduce risk across your portfolio, but to eliminate all risk, you might be giving up some upside. You might be giving up your ability to keep up with inflation. And the most challenging thing is not getting out of the market. Anybody can do that. Anybody can have a sell discipline. But what's your buy discipline? When do you get back in? Now, I've had clients that have gotten out at different periods. They pull all their money out when Biden was elected. They pull all their money out when Trump was elected. They pull all their money out when there was this conflict or that. And they go years, multiple years without getting back in, and they missed a big opportunity. So it's important. Don't be emotional. Have a strategy and make sure you've really thought through it in a level-headed way. Those are my top strategies for dealing with a scary market. It's been scary. It's been a scary few months, and there's likely going to be more scary things ahead. Do you have the infrastructure, the team around you to navigate the financial world? Do you have the time to do it yourself? Do you want an advisor or a team of professionals to help you navigate? Hopefully these strategies will help you on that journey. And that's my money monologue.